and then I'll switch over. Good morning, everybody. Today is 4/6. We're starting chapter 7, and you guys have the quiz, the reading quiz that'll be due by the end of day today. And jump in and do it anytime, and it'll give you about 15 minutes. And there's roughly 10 questions or so on the reading. And again, that's extra credit based on how well you do, just like the other quizzes. So 7 is 1 point, 8 is 2 points, and 9 or above is 3 points, and those go towards an exam grade. All right. Chapter 7's pretty short. It's got some complicated material in it, but for the most part, you're not going to be tested on that stuff, so I'm not going to focus too much on it. I want you to understand it, especially those of you going on in accounting or finance or entrepreneurship. But in terms of what types of material are going to be tested on chapter 7, it's really going to be on the concepts. All right, so I'm going to share the sheet with you. And if you have any questions or anything, just pop in the chat, send it to me, or send it over overall. So we are section 1. Today is 4/6/2020. Okay. So first we're talking about classifying liabilities. And you have two types: current and non-current. Current, it's going to be due within 1 year or 1 cycle if longer than a year. Non-current, sometimes you'll see it called long-term, due beyond 1 year, or the company intends to refinance with long-term debt within the current year. And with the refinance, typically they'll have a plan or an agreement in place to refinance. So you still classify it as long-term, even if you plan to refinance it and it's coming due within the year. All right, we're going to talk about bonds. And these are usually issued to the public. So private companies can issue bonds, but they must follow public company filing guidelines and GAAP on their financial reporting. Okay, so the concepts are really important in this chapter. We covered little bits of it moving up, so I'm going to try to focus on the talking about the concepts and then do the quantitative questions that we haven't had similar types before. And I've got a lot of questions on here that I don't plan on covering. And actually, I think, depending on how this goes, we may get through it just on Monday and Wednesday. So let's jump in. Like I said, it's very important to read the chapter, the concepts, especially the first 4 objectives. And in the first objective, they talk about what's current, what's non-current, some other types of liabilities, and then we talk about pay liabilities, which sometimes would be called wage liabilities. and payroll taxes. And you have, it's called OASDI, which was the old age. And I believe survivors. Disability income. And really the ones that we see most would be FICA, which is Social Security, and Medicare. And right now, the way that they're paid is Social Security is 6.25, 6.20, I think. Yeah, 6.20% by employer and 6.20 by employee. Medicare is 1.45% by employer and 6.2 by employee. So when a company pays a worker in the US, there is a salary, and then deducted from that are state, local, if applicable, and federal taxes. These are withholdings required by law. And they get remitted to the US government. Okay. And then there's also FICA and Med withheld at 6.2%. And 1.45% respectively, and submitted to the government. Okay, so they have pay, and the salary, gross salary, is what is earned. Net salary is what gets paid after deductions. The company then adds its portion of payroll taxes and remits to the government. Okay, so it's pretty straightforward. So we have an example below. It says they earned $60,000 from his job. And so this $60,000 would be his gross salary. he had 15% of his gross pay withheld for federal income taxes, 6.2 withheld for FICA Social Security taxes, and 1.45 withheld for Medicare taxes. And so they're asking what was Bo's net pay. All right, before I jump up, I just wanted to say that the Medicare, or excuse me, Social Security is capped at about 131,000. That means they don't deduct any more beyond that. And I made a mistake here. This is 1.45%. And this is not capped. And keep in mind that these are deducted from regular earnings. So dividends, and other financial income are not subject to these taxes. In our new kind of gig economy, where many sort of workers are not employees. Oh man, I just brain cramped. It's 1099 contractors. They are subject to paying the full amount, approximately 15% themselves. And that's typically called a self-employment tax. Okay, sorry about that. Back to our question. So we have 60,000 gross. We have 15% of that. So let's do the math.
Can you scroll up a little?
Yes, give me 1 second.
Okay, thank you.
Thank you for asking. 9,000. Yeah, you guys see it's slightly different than I do with this stupid bar that I have on my screen. So many companies now make these bars and they say you can move them, but you can't click on them anywhere. Okay, all right. So 60,000 gross pay, 9,000 in taxes, federal taxes. And this is just how I calculated it, 15% of 60,000. And then we're going to have 6.2%. I don't know what that was. 3,720 in Social Security. That's 6.2% of 60,000. And then the last piece will be 1.5% or 1.45%. is 870. And so we take and subtract those items out. So we got 60,000 minus the 9,000 takes us to 51,000 minus the 3,720, 47,280 minus 870 is 46,410 is net pay. So our answer is B. All right. Throw up the poll. Have any questions? Please type it in the chat if you don't. Please click no. So there's one question so far. Type that question in the chat for me. I'm going to end the polling, share the results. Okay. If that question pops up, I'll address it. Otherwise, I'm going to move on to the next one. (7.2). Everybody's favorite cartoon character, Homer Simpson, worked for the Springfield Power and earned $5,000. Federal income tax withholding is 15%, FICA 6.2, Medicaid 6. How much cash power will Springfield Power pay the government for FICA because of Homer's December earnings? So again, this one you just have to be careful with making sure that you're looking at cash for FICA. And so with this part, you have to remember to pick up both pieces. I think I'm going to have to run out of room here, so I'm just going to move this to the next page. And then I'll scroll up. So the company pays 6.2%, and Homer pays 6.2%. So cash to government is 12.4%. So 5,000, not 50, times 12.4% equals $620. Okay. 7-3 is a little practice for you. So it's not taken out twice. Half is paid by Homer and the other half is paid by the company. But they're asking how much cash will the Springfield Power pay the government because of Homer's December earnings. So technically, Homer has $310 withdrawn, and the company pays $310, but it sends the 620 total cash to the government. Okay. You're welcome. Okay, so now take a minute and go through and classify 1, 2, and 3, or 1 through 4 as current, long-term, or neither for liabilities. This just kind of tests where you are at and your understanding, and this will be important for all of the payment types that we talk about in this chapter. Excuse me. No, you don't have to private message. Thank you, though. This is more just kind of a self-reflection. Okay. All right. So it just says put an X, whether each description reports in a current liability, long-term liability, or neither. So the first one, there's a little twist to it. It says amounts owed to employees for work performed in the last week of December, so, or 2011. And so the hook there is, oh, well, it's going to be paid in 2012. So is that long-term or short-term? And of course, it's a current liability because it's going to be paid within 1 year. So current liability. Amount of loan payment due in 2012. So that's within 1 year. The estimated amount owed for utilities, the exact amount will not be known until January when the bill is received. So that's current liability. And a 3-year note payable due in January is long-term. Okay. Run the poll there and see if we have any questions. Click no on the poll. Okay. All right, I'm going to go ahead and close that out. We don't have any questions, so I'm going to share that and then move on. All right. A little bit further. Okay, so the following comes from the payroll department. Last pay period of 2012, employees will not, or 2011, excuse me, employees will not be paid into 2012. So determine the amount the balance sheet will report as wages payable. Okay, so for wages payable, the liability is going to be the net amount and so we need to calculate the net amount. The wage expense is the gross amount. What type of liability is wages payable? It's a current. And to what party must the company pay the FICA taxes? The US government, or sometimes we'll say US Treasury. So calculate those two and type that in private message to me. The answers are starting to roll in, so I'll give you another minute. Excellent. Guys all did pretty well. So your net employee payable, oh, sorry, I'll call it wages payable, would be the 330,000 minus each of those, which you guys all pretty much got, 256,755. So net pay would go here, 256,755. That's just kind of something you have to put to memory, that the wages payable are what's going to the employee, whereas the wage expense is the gross amount, which is the 330,000. Okay, good job.
When we're talking about the gross amount, like to start, like why is it called gross if it's not, like when you say gross, that nothing's taken out, like to start with?
Why is it called gross?
Yeah.
I'd have to go back and look at the definition, but I'm assuming definitionally speaking, gross could be like without reduction.
Okay.
That's my
Thank
best
you.
guess. I never thought to ask that question, so it's a good one.
All right.
Mhm.
Thank you.
All right. Okay. All right. And I will find that out for you. All right. So now we're moving on to liabilities that occur in the period, but are not definitely determinable. So typically you know exactly what you are going to pay. So you'll see the term definitely determinable in some of the questions that you have, and that means we know exactly what we're going to owe. But there are liabilities that'll incur within a period that we don't know exactly how much they're going to be. And so we estimate these liabilities the best management is able to and report the estimate and how it was done. So this is similar to bad debts expense estimate, but not the same. All right. And the reason we make these estimates is due to the matching principle to match the expenses when the revenue is generated. So for warranty, which this is your standard that comes with the product at no charge, no additional charge. Company must estimate the liability. And so they'll create the liability and expense And then in the future, the cash outflow for expense will be charged against the liability. Not to a new expense. Okay. So we're talking about typically what you would get with a product warranty. Says it's good for 90 days or a year. Some come, with the longer term, but typically this is just the standard warranty. So it says in its first month of business, Fishnets Inc. sold 8,000 nets with a 3-month warranty for $10 each on account. It estimates that 1% of its sales will be uncollectible, and that warranty costs will be approximately $100 on its sales. So we have 8,000 times $10 each gives us $80,000 in sales times 0.01% gives us $800 bad debts expense and allowance for doubtful accounts. And then it says we have $100 in warranty, liability, and warranty expense. So we have to find what sort of meets that. It says bad debts expense of $800 and warranty expense of $100 on its income statement. So that's correct. Okay. But let's look through the other ones. Allowance for uncollectible accounts of 80, nope. Bad debts expense of 80, nope. And allowance for uncollectible accounts of 80. So nope. The answer is A. Any questions so far?
How did you get that answer again?
So the 100 was given, and then it said it was going to be 1% of its sales. And so it said it sold 8,000 nets for $10 each. And so I took the 8,000 multiplied by 10 to get $80,000 in sales. And then 1% of that is bad debts expense and allowance for doubtful accounts, and $100 for warranty liability and warranty expense. Okay.
Okay, so how can you tell it's bad debts? At the 800.
Because it's saying that it will be uncollectible. So that's bad debts. That's from the last chapter.
Oh,
Okay.
okay.
And it's an estimate. They don't know for sure that that'll be the case. All right, jumping into our next question. This is Matt's Rug Company, and we just want to classify this. We want to show the effect of the following events in the accounting equation. Had sales of 100,000 in 2011, all on account. The cost of goods sold was 60,000. So for assets, 100,000 accounts receivable, 60,000 reduction in inventory. And then retained earnings, 100,000 in sales, 60,000 in cost of goods sold. My little sentinel is back, so don't let the barking startle you. All right. expects that warranty expenses will be 6% of sales. So I'm going to put the calculation in here. Hey. No, Zozo. No. No. All right. So 100,000 here multiplied by 0.06 gives us 6,000. Sorry, I did that in the wrong column. Okay. And so we're going to end up with a warranty liability of 6,000 and then 6,000 for warranty expense. Okay. Now the third one pays 4,000 for cash warranty obligation. So we paid 4,000 in cash outflow. And then we had a reduction of 4,000 in the warranty liability. All right. Part B, write the amount even if zero as of year into December 31st where the item is found. So we have warranty expense, amount, 6,000. Financial statement would be in the income statement. Your estimated warranty liability. So here we'd have 2,000 and that's netted from the 6,000 minus the 4,000. And that's on the balance sheet. Sales of 100,000. Income statement. And cash paid for warranty obligations, 4,000. And that would be on the cash flow statement in the operating section. See if I can get that all on one page. Okay. All right, throw up the poll, see if there are any questions. No, Zozo. I should have let her out on that one. Some guy just watched his kid throw trash on our lawn. Only 14 have responded so far. Anybody else have any other questions? So that's pretty much it for today. We've only got 3 minutes left. Don't forget to do your quiz. And
What is
I
that
will
do again?
see you on Wednesday. The quiz is due tonight by, I think it's set at 11:55. So you have to start it basically at 11:40 if you want full time.
Okay, thank you.
All right. Got one more question here. So I'm going to share the results of that poll while I check the question. Oh, thank you. Wasn't a question. You guys have a great day. And I will talk to you on Wednesday. If you have any questions, email me or stop by during office hours.
Thank you, Professor.
Thank you, Noah.
See you Wednesday.
Yes, take care.